So this whole whipsaw inflation is a really serious threat. And it's something that we have to think about, not just as investors, but also as consumers, being careful how we save our money, how we spend our money, where we spend our money on, and what's going to happen with that.
Is lifetime income report still trucking along?
It is. Yep.
Okay.
Yep. It is. We don't have a promo out for it right now, but we're working on some in the background. But yeah, lifetime income reports trucking along. A lot of our names have actually held up really well compared to the rest of the market. If you look at some of the statistics for what's working in today's market and what's not working, dividend yield is one of the biggest kind of determinants of whether stocks are actually holding up or really falling. Yeah. And of course, that's focused on dividend payers, and our portfolio has held up relatively well, even with all the carnage that's going on in the market.
Yeah, so let's talk about that a little bit, because I know that you're very careful about selecting the dividend stocks that are in the portfolio, and you're conscious of what's going to happen in a bear market. And also we have a recession that's approaching. So there's economic issues that are facing the same dividend paying companies. So just walk me through your thought process. I know we have this conversation a lot, but I'd like to hear you actually talk about it in this new environment.
Sure. And I'm really glad that you actually said those two things separately, a bear market and a recession, because those two things, they're very different, and sometimes they happen at the same time, sometimes they're different. But we've gone through a bear market period. We are in a bear market right now. And the deal is that companies that generate reliable profits, companies that pay their investors dividends, companies that have cash coming in will actually hold up relatively well, even during a bear market. A lot of times that's because investors are looking for a safe place to put their capital. So they may be pulling their money out of the Zooms and the Pelotons and the DocuSigns and all of those more speculative stocks and figuring out, where do I put that? Well, I want to put it in the market, but I got to put it somewhere safe. And so they move that into dividend stocks. And often that's why dividend stocks actually hold up better than the overall market. It doesn't mean that the stocks don't pull back sometimes. The market ebbs and flows, stock prices ebb and flow. But whenever we put on a new position in lifetime income report, a new dividend play, we use what I call my 3 pillars of successful income investing. And the first and primary pillar is protect your capital. That's something that Bill, my boss and mentor back at the hedge fund, kind of drilled into our heads over and over. Protect the capital that you've invested. And that means investing in stocks that are at a very attractive price. They're cheap compared to the earnings that the company generates. They're already trading at a low price compared to what you can expect over time from this company. So if the market pulls back, these stocks are less likely to pull back significantly because you already got a value when you were buying those stocks to begin with. So I'm really proud of the way that a lot of these stocks have held up during the bear market. The other exciting thing that I love about this type of investing is that you're always getting cash coming into your account. Sometimes you need that cash for day-to-day expenses, but if you don't need all of that cash immediately to spend on things, you can actually use that cash and take advantage of the lower stock prices. So if your stock dropped by 5 or 10%, you can take that dividend, buy new shares of stock, and you'll get more shares because you're getting a better price for those shares. And then as the stock comes back, you'll actually make more money. Plus, you're now going to get a bigger dividend because you own more shares of that same company. So bear markets, yes, they're challenging to work through, but they actually can create a lot more wealth if you know how to deal with them along the way.
I have your book here, and I just want to show people that you outline your strategy in lifetime income report, but you also have the rich retirement letter. A lot of the like basic concepts of what you describe in the letter, and then the actual picks are located here in this book. So let me hold it up again, because I think it's important. If people are going to follow Zach Scheidt, they should read this book. That's correct, right?
Yeah, I think so. I mean, we worked really hard to put a lot of great ideas into that big book of income. And it actually includes a lot of important information for investing in the market and getting income from the market, but also alternative ways of generating income that are outside your traditional, buy stocks and generate dividends through or generate income through dividends. So it's got a lot of, whether you're into markets or whether you're into just kind of finding new ways of making income in your day-to-day life. It's got a lot of different really neat ideas. So it was fun writing it, and I'm really glad we did.
Yeah, it's a great book too. It's like an easy read, and you get the concepts come through really easily. I do want to get to some of the alternative ideas. That's part of what I want to talk to you today, because I think when we head into tough financial markets for stocks and bonds and things like that, people start looking for alternative ideas. So I do want to talk about that in a second, but I want to get to the second part of my first question was, as opposed to a bear market, what happens to dividend stocks? What happens to larger blue chips when we start facing a recession? I mean, we've actually entered into recession technically already, even though the president won't admit it.
Yeah, it's interesting to think about what do we call a recession technically. So it's technically when the NBER, the National Bureau of Economic whatever, when they say we're in a recession. So it's basically saying we're in it when we say we're in it, which is not a very good definition. But traditionally it's been when our economy has 2 quarters of negative GDP growth, and we just got our second quarter of negative GDP, which is gross domestic product, basically. How much did our economy generate over the last 2 quarters? So yes, by all intents and purposes, we are in a recession, and we're also in a bear market. So during a recession, it means that, for me as an investor, I think about we have to be a lot more careful. Think about being a coach on a football team during your offensive periods where you have the ball. You want to be aggressive. You're taking the shots down the field. You're trying to score points. When you're on defense, you're doing just the opposite. You're hunkering down. You're trying to protect what you've got. You're trying to keep the other team from scoring against you. And that really is a lot of what we need to do as investors right now. With that said, I do want to. So I think that a lot of people get fearful when they hear the word recession, and they think that it means, the end of the world is coming. And there are lots of different types of recessions. Sometimes recessions are shallow and they're done in a few quarters. Sometimes recessions last a lot longer. And we don't know what this recession is going to look like. There are some positive signs in the economy that show that maybe things are getting a little bit better. There are some long-term risks that I'm very, very worried about, especially with as much money has been plowed into the market. And all the stimulus checks, everything that's been done over the last 2 years that now we kind of have to pay the bill for. So that's why I think that it's really important to be taking these things a day at a time, a step at a time. Keep your eyes wide open, understand what's going on in the overall economy, what areas are going to be strong, what areas are going to be weak. We're seeing a lot of opportunity for energy companies, whereas maybe some of the more international manufacturing companies could have a lot more stress, a lot more challenges over the next year. So it's a time where you really have to be careful to understand what is going on, not just in the market. I kind of hate that term, looking at the market. I'd much rather say what's going on in this industry, what's going on in this industry, what's going on for this company, because as an investor, that's really where you can make a difference with your overall wealth, is understanding what areas are vulnerable and what areas can profit as these new changes take place in our economy. So I don't know if that helps to kind of explain the difference between a bear market and a recession. The one other thing I did want to mention, though, is that the market, here I am using that term again, but stocks in general tend to advance ahead of what's going on in the economy. So we got this bear market well before we got anywhere close to having 2 quarters of negative GDP. The market peaked at the beginning of the year. It's been trading down for 6 months now. And now we're just saying, okay, now we're in a recession. So if that's true, And if the market has already kind of traded lower in anticipation of a bear market, then it means that we could have already kind of priced that in, and there's a chance that we could have a bear market rally or some really positive events in the market, even while we're kind of entering the recessionary period.
How then like you're talking about bear market rallies, which like nothing goes down in a straight line. And there are rallies, and we've already seen a couple. How does that impact dividend stocks directly?
Well, I think it goes back to what we were talking about earlier, where you can actually use the dividends that you receive in your account to buy new shares of stock. And then if that happens typically during a bear market rally, then you will have bought during the bear market. And as the market rallies, then you wind up with those shares actually making more money for you, creating additional wealth. I do think it's interesting and important to understand kind of what drives a bear market rally. So during a bear market, you have a lot of fear in the market. You have a lot of investors moving out of stocks, sometimes just out of every stock. You know, you probably know people, I certainly do, who said, forget this, I'm done with this. I'm done investing. I'm not going to lose any money in the market ever again. I'm out. And so they close their accounts, or they pull, they sell all their stocks. And then the market starts to move a little bit higher, and all of a sudden they have those pangs of regret as they see, well, I could be making money as markets trade higher. And so those traders can jump back in and help to drive stock prices higher. The other side of that coin is there are a lot of aggressive traders, and even more so now that we've got the Robinhood market and we've got Reddit and we've got a lot of kind of novice investors trying to play both sides of the market. I remember when I was a brand new trader and thought that bear markets were easy to make money in because you could just short stocks that were going to go down. But what happens is that once stocks start to move higher, those aggressive short players wind up losing money for every tick that a stock moves higher. And so there's one side of, being motivated because you're not making money, but it's even more motivating if you're losing money every day that you watch the stock market trade higher. And so those traders often have to buy shares simply because, gosh, they're losing money every day that the market trades higher. And they either have to buy them out of their own free will because they want to stop the bleeding, or their broker may step in and buy for them because they don't have enough money left to lose anything. And so that's why bear market rallies can be so vicious, so strong, so quick, because you have human nature and fear working on your side, helping to drive more people into the market and drive those stock prices sharply higher. The nice thing about being a dividend investor during that time is that dividend stocks don't swing nearly as much to the downside or to the upside during a bear market rally. Typically, during a bear market rally, you'll see some of the more speculative stocks go from maybe $13 up to $25, and that's almost a double. But of course, they used to be at $150, so it doesn't really look like that much. Meanwhile, the dividend stocks, they'll bounce, but they won't bounce by quite as much. The thing that I would really warn people against, and I've kind of been pounding the table on this, is when you see those speculative stocks trade sharply higher during a bear market rally, that is not a signal for you to ditch your safe dividend stocks and say, okay, now I can go into the speculative stocks because they're starting to move higher. Because a lot of times those are false signals. They suck in money as the speculative stocks move higher, and then wham, they get hit again, they go down to new lows, and people who got sucked into that way of thinking are once again stuck losing money. And it really makes me sad to see families in that situation because it's completely unnecessary.
Yeah, I'm glad you bring up your family, because you were talking about fielding a football team and playing defense. You have practically a whole football team in your house.
That's right.
How's the family doing? You have 7 children?
I have 7 children. I still have 5 in the house. And number 3 is going to college this fall. So I'm sorry, number 4 is going to college this fall. So I've got 5 in the house. 2 are going to be heading back to college when the summer's over. So we're down to just a little family now. But they're all doing good. We're enjoying the summertime. enjoying, just a little bit of downtime, being able to be together a little bit more. And yeah, we live in Georgia, so it's sunny and hot and humid, and it makes for good times going to the pool or just being able to, just enjoy the good weather.
Well, in previous conversations we talked about how that's what got you interested in dividend investing in the first place, is because you had a growing family and you've been able to finance college and high school and whatever, your house, retirement planning through 2008, the crisis, through the doldrums of like 2015, and now through the pandemic. So just a little personal perspective on what it's been like to go through the rough periods in the market, because there's a lot of people that are trying to manage what's now a bear market and oncoming recession.
Sure. No, you're absolutely right. And those have been some really formative times for me and for my family as well. To be perfectly frank with you, I've told the story a few times, but 2008 was a really, really challenging time for me to understand what I wanted to do with my career, with my family. I've told the story about it. My wife was actually pregnant with our twins, and they were born in October of 2008. So they're going to be 14 years old here not too long. But I was working at the hedge fund at the time, and we had, all the carnage that was going on in the market, and our fund was actually holding up relatively well compared to the market. Bill was great about protecting the wealth that our investors trusted with us, but it took a lot of effort. It took a lot of my attention, and I was putting in very, very long days while expecting child number 5 and 6, I guess it was at that time. So I remember being next to my wife's delivery bed, and kind of the whole push, honey, you're doing great. And meanwhile, I had the cell phone and I'm barking orders onto the floor, sell, sell, sell. And it was clear that I was not where I wanted to be. I wanted to be wholly with my family and really focused on them. And so that is actually the impetus for me leaving the hedge fund and starting to just invest on our own and really changing my career to a place where now I help families grow their wealth by sharing the strategies that I've learned, by sharing what I'm seeing in the overall market, by really kind of teaching many people about how to generate wealth from the market instead of going in and doing the 16-hour days at the hedge fund. I still love markets just as much as I did before, but I can do it in a way now that actually gives me time with my family and also helps me help other families that are probably in the same boat that I was, 14 years ago. I do think that it's really important during these times, these turbulent times in the market, to understand how to protect your wealth and to also have some alternative ways of generating income. So for me, that actually, I had something valuable. I knew how to trade during a bear market. I knew how to invest in a way that protected assets. I knew how to take advantage of the opportunities that the market was giving us at that time. And so I was able to share that with other people. And I was able to be paid for the research that I put out, for the writing, for the recommendations. And so it gave me an extra stream of income on top of the investments that I was making for my own family. And I think that lesson can apply to a lot of us because we're all good at something. We're all passionate about something. I was going to save this for a little bit later, but I've got, I don't know what it is about our family. I'm one of 11 children. So big families run in my family, if that makes any sense. But I've got some of our siblings were getting together this summer, and we were talking about how so many of us have little side gigs that we like to do on the side that generate income for our family. So there must have been something that we learned along the way as we grew up about entrepreneurship or just kind of scrapping together some extra income from different ways. So I've got a brother that's really into golf, and he decided to create a little business where he buys and sells golf clubs, and he gets great deals on golf clubs and refurbishes them and sells them and makes a good living on it. You can probably see behind me, my sister painted one of these paintings I love old World War II airplanes. And my daughter actually did the other one. She just gave that to me for Father's Day this year. I haven't decided where I'm going to hang them yet. But my sister is a portrait artist, and she makes great money for their family by doing something that she loves that she would want to do anyway. But you'd be surprised at how much somebody pays for a portrait. I've got a brother who's great at technology. He just loves kind of geeking out on websites and how the internet works and so forth. And so he's reached out to several small businesses, and he built their websites for them and hosts them and makes some extra money for his family doing that. I've got another brother who loves whiskey of all things, and he buys collector's items, bottles of whiskey, and sells them occasionally to different people. I got to be careful. I think everything is. I don't know exactly what the laws are as far as alcohol distribution, but it's just a little small gig that he does that adds some extra family income that he can use to take his family on vacation or do something special. So I think all of those are just good examples of the fact that even if you're not deep into the market, even if you don't have a lot of capital to invest, there are things that you can be passionate about, that you can enjoy, that can also generate extra income. And that's really important in today's world where inflation is causing such a big challenge for many families. And when we really need to find some extra ways of generating income just to make ends meet and to keep budgets where they need to be.
Yeah, let's talk about inflation a little bit. It's been a big top of mind topic for a lot of investors. And also, we just saw the euro reach parity with the dollar for the first time in 20 years. When you're thinking about dividend stocks or just stocks in general, how do you think about just the dollar and inflation and how that plays into the earnings reports that companies are going to be putting out?
Yeah, so that's a lot to unpack there, and I'm thinking of three different categories there. We've got inflation, we've got the U.S. dollar, and then we've got investments. And so I might want to tackle those in three different ways, or kind of in three different quick conversations. So the first on inflation, it is a big problem right now, and I've actually been looking at kind of how this dynamic is working out, and to be honest, it looks a whole lot like what we saw in the 70s. And what you may not realize is that during the 70s, we actually beat inflation several times. So inflation got really high, and then the Fed raised interest rates, and then inflation kind of backed off. And then the Fed said, okay, all right, well, let's let the economy recover. And then inflation perked up again. And they said, oh, wait, we gotta put the kibosh on this, and we gotta help slow things down. And we kind of had this, what I call whipsaw inflation environment. And that is exactly what I think we're setting up for here in the United States. And that creates a lot of challenges. So inflation, we just got I guess it was a week or two ago, we got the CPI report that showed that inflation was above 8%. And depending on whether you're looking at core inflation or the actual headline number, but it was very, very high, the highest that we've seen in 40 years. However, some of the stuff that we're seeing real time is actually showing that inflation is pulling back. So that inflation reading was for the month of June. And during the end of the month of June, heading into July, we started to see inflation or some of the prices pull back. And we've seen that continue through August. So think about what you're paying for gas at the pump. It's actually come down quite a bit. The price of oil has come back quite a bit. The price of industrial metals like steel, iron ore, copper, those have pulled back for some different reasons. Sometimes it's because demand in China has been weakening. Sometimes it's because supply has come online for some of these resources. And other times it's because demand here in the United States has been hurt by higher interest rates. But the point is that we're starting to see some of these prices come back down, and it's sending the signal to the Fed that, okay, what you're doing, raising interest rates, is working. Inflation is backing off. We can take a breather and watch and see what's going on. The problem is that as the Fed takes a breather, watches to see what's going on, watches to see if the economy is holding up okay, and if inflation is settling down, that gives more of a chance for inflation to pick back up again. I've heard the analogy, and I love this analogy. You know, when you get sick and you're supposed to take not a vaccine, you're supposed to take the medicine that's going to kill the bacteria or whatever it is that you have.
Antibiotic.
And they tell you, yeah, antibiotic. So, you know, when you get sick and you take an antibiotic and the doctor tells you, you have to take the full dose. You're going to start feeling better, but don't stop taking the antibiotic. Well, if you take half of that antibiotic, you feel better, and then you go ahead and go about your business and stop taking it, the sickness is going to actually flare back up. And not only that, it's going to learn to actually be resistant to the antibiotic. And that's why we have, antibiotics that have to continue to evolve to face, the diseases that are going out there. Well, inflation is a lot like that. If the Fed gives the economy half the dose that it really needs and then backs off, well, then that inflation picks back up and it becomes more persistent because consumers now expect, and it's ingrained in their heads, we are expecting inflation to continue to be high, which means we're going to spend money now while the dollar is worth something, because we know that our dollar is not going to be worth as much later. So this whole whipsaw inflation is a really serious threat. And it's something that we have to think about, not just as investors, but also as consumers, being careful how we save our money, how we spend our money, where we spend our money on, and what's going to happen with that. So that's one side. The second is the US dollar. You were talking about how the US dollar is now at parity with the euro, which means that the dollar has been very strong. It's actually increased in value compared to other currencies. So that gives us two different pictures, right? Inflation, when you look at inflation, it means that if inflation is high, it means that the dollar is not able to buy as much. So that would mean a weak dollar, right? But when we look at the dollar versus other currencies, the dollar is actually very strong. It can buy more euros. So that dynamic is really challenging for financial markets, because we're seeing two sides of the coin here. The reason why is because the US is raising interest rates more so than other currencies, other countries. And so the dollar, for international investors, the dollar is the best bad thing for you to own. It's still bad. We're dealing with inflation and dollars are worth less and less and less, but at least it's not as bad as what we're seeing with the euro or with many other international currencies. And so a lot of money is moving into the United States, driving the dollar higher, which affects the way that companies are able to do business, especially international companies. So that brings us to the third question: what dividend stocks are going to do with this strong dollar? And that's the important thing about where we invest. When the dollar is very, very strong, it hurts companies who are based in the United States and do business in Europe or many other places. But let's use Europe as an example, because you were talking about the euro at parity. Think about this. If a company like Procter & Gamble made $100 million in Europe in 2021, they made 100,000 euros in profit. Now, if they make that same 100,000 euros in profit this year, that means that they made $100,000 in profit. It used to be that it would have been $120,000 in profit because the euro was stronger back then. But now the euro is weaker compared to the United States. So even the same amount of business over in Europe is causing less profit here in the United States for a company like Procter & Gamble, simply because of the currency conversion. And we've seen many international companies like Procter & Gamble, Coca-Cola, even Netflix and some others say that the currency issues are causing problems for their overall profits. Some investors want to look the other way and say, oh, well, it doesn't matter. It's just a currency issue. But that's real profits that are not being generated because the US dollar is much stronger, which means your international revenues are much, much weaker. Your international profits just don't count for as much as they used to. And so as investors, we really want to be focused on companies that do business here in the United States. They make their stuff here in the United States, they sell it to US customers, because those are the companies that are going to actually profit from the US dollar being strong, or at the very least, they're not going to be hurt by a strong US dollar. Some of the companies that I really like in this type of environment are US banks. And that's for two reasons. One is the fact that they do most of their business here in the United States. So the regional banks like your SunTrust or your Regions Financial, or there are many different, kind of very healthy regional banks that lend money to US customers. So those companies do business in the United States. They're not really affected by the currency issues that are causing problems in so many other areas of the market. And the second thing about those particular dividend stocks is that as interest rates move higher, as the Fed hikes interest rates, these banks are able to charge higher interest payments for the loans that they make for companies around the country. So they're able to generate more profit. They call it net interest income, NII. They're able to generate more interest income despite the fact that we may be heading into a recession, or we are headed into the recession, depending on which technicality you want to follow. They're able to generate more income, and they're also trading at a very low price. So there's some great dividend stocks that you can buy in that area of the market right now.
I know you just did a segment or a series on Walmart. How Walmart's a big multinational company. How is that environment impacting Walmart or Amazon or those companies? I just use Walmart as an example because you just did a series on it and it was intriguing.
For sure. So Walmart and Target to some extent as well, both just completely botched their first half of this year. Just absolutely. It boggles my mind. These are the two of the companies that are supposed to know what they're doing. They're supposed to be able to to anticipate what their customers want, and they just screwed it up royally. And Amazon also to a certain degree. So these retailers, they basically bought a whole lot of merchandise that they wanted to sell to customers that included, patio furniture and big screen TVs and things that people would want at home. The problem is people are not buying those things right now. People don't want to be at home right now. The people with money are spending money on travel and entertainment. We just got a huge report from Amex, American Express, that said their more wealthy customers are spending money on travel and entertainment, and that's where the consumer spending is going. Meanwhile, consumers who are not wealthy and are being hurt by this, this inflation, they're trying to save money on everything that they can, and they're not buying patio furniture. They're not buying big screen TVs. They're buying back to school stuff at cheap prices that they can get their hands on, but they're just simply they're looking for better deals other places. And so Walmart and Target and Amazon all wound up with the wrong merchandise filling their warehouses that they couldn't sell, and they've had to discount prices and just do whatever they can to get rid of this stuff, to move it off their shelves so that they can bring in more economical things for their customers. So I do think ultimately Walmart's going to get it right. They're going to recover. They're going to be okay. And they are a good long-term dividend stock. But they're going through a big challenge right now. And it may take a few quarters for them to kind of work through all of this inventory that they've had aside. But Addison, I wanted to share a couple ideas that are tied to those names that are actually benefiting from the big missteps that specifically Walmart and Target have had. So I don't know if your family has ever gone to a dollar store or Dollar Tree or some of those super discounted stores. My kids loved it. We do allowance sometimes on Friday afternoons, and then over the weekend we'll go to the dollar store and Kayla will pick out a little toy here and there or something. But those very deep discounted stores, the way that they're able to offer discounts to their customers is they often buy huge amounts of merchandise from the big retailers that then are discounted because the big retailers can't sell them. So this kind of a situation is absolutely perfect for a Dollar General, also like a TJ Maxx or a Ross Stores. TJ Maxx is TJX, I believe that's the stock ticker symbol. Ross Stores is ROST. Dollar General is DG, and there's DLTR for Dollar Tree. I think those are the right symbols, but you can look them up as well. But these companies are now able to buy a ton of great merchandise from the Walmarts, the Targets, the Amazons, who are just trying to get rid of whatever's on their warehouse shelves. They're able to buy them for pennies on the dollar, and then they're going to be able to sell them to their customers for much lower prices. It's really a win-win, because the discount retailers are now going to be able to generate a profit. They're going to be able to get people to come into their stores, and that's a really good thing, especially in this back to school season. Meanwhile, customers who are really hurt by inflation are going to be able to buy some things that they would like to have at super discounted prices. So that helps, just the mom and pop consumers to be able to buy things at a lower price. And then for us as investors, being able to pick up on some of those retailers, I think that's where you're going to see a lot more opportunity in this inflationary environment, and not necessarily buying shares of Target or Walmart or even Amazon right now.
All right, we'll make sure we follow up on Dollar Store. I think Marshall's is probably in that group too.
Yeah, and I believe Marshall's may belong to one of those overall companies. But you're right. Yeah, that's the concept that we're thinking about. The companies that buy all of this merchandise when it's on sale, when the big retailers can't get rid of it, and then they're able to sell it to their customers at their leisure when it makes sense at a low price for a profit. It's kind of a genius way of doing business when it works.
Yeah, when it works in a good inflationary environment.
but one of the problems that these companies have had is that for when over the last 2 years, when consumers were buying everything they could get their hands on, the discounters couldn't find merchandise at cheap prices because Walmart, Target, they didn't have extra inventory to sell. But now those companies do have extra inventory to sell to the discounters. And so now their business model is back in vogue again.
That's great. All right, I'm going to hold up your book again. The Big Book of Income, and also a Lifetime Income Report.
Yeah.
You want to talk to Zach Scheidt? I'm going to give you one last word, Zach. Retirement.
Well, I would say.
Well, wait. Retirement isn't what it used to be. What do you say to that?
Yeah, it's not what it used to be. I'm thinking about my grandpa, who he is 101 years old, and he is the quintessential traditional retiree. He worked for Cummins Engine, Arvin's Tool and Die. He was a tool and die maker, and he worked really hard his whole life, and then retired the way that you would expect most people to retire, and had a pension and all of that. Those days are pretty much gone. And I think that's both good and bad. It's frustrating, because if you are one of those people who expected to work until you're 59 and a half years old and then retire and never have to go back to work again, that is less likely than ever to actually work for you, because life expectancy is longer. So whatever you saved may not last as long as you want to live, but that's a good thing, right? If we're living longer. So on the bad side, it's tougher and tougher to outlive your money, and that's frustrating. On the good side, there are more and more ways that we can make money, even doing the things that we love. And that goes back to what I was talking about with my brothers and sisters, who are all super creative, more creative than me in a lot of ways, at generating extra income for their families. And that's part of what we've got in the Big Book of Income, and what I talk about in the Rich Retirement Letter, some of the alternative ways that you can make income during your golden years. And also in the market. I think if you're really smart with the way that you invest, there are plenty of great ways to generate extra income from the market. There are plenty of great ways to protect your wealth now, to grow your wealth as we eventually exit this economic slump, and that can help you to be able to have income that you need over time. And that's really my passion, is to be able to help people through the Rich Retirement Letter to be able to think carefully about how they want to invest, about how they want to make that extra income, so that they can focus on the things that really matter. I made that decision back in 2008 that I was going to focus on my family. I was going to leave the hedge fund and spend the time with the people that meant the most to me. And that's something I really want to encourage people, especially people who are headed into that retirement stage of life. That's a time when you want to be focused on the people that matter to you. You want to be able to enjoy life. You want to be able to travel and to do the things that you've looked forward to for a long period of time. And so my goal is to help you not have to worry about finances, but to get excited about how you can make those finances work for you, so you can focus on the things that really matter in life. That's really what's the most important when we think about the big picture of life, right?
Yeah. I noticed that you're publishing quite a bit of the ideas that you're discussing today on LinkedIn. So I get your LinkedIn newsletter, which I think is really good. And mostly you outline the philosophy of how you're approaching the markets. So I just want to encourage people to check you out on LinkedIn, because it's a really efficient way to keep up with your thinking. That's where I read the Walmart stuff.
Oh, good. Yeah. Well, I do love it there. So definitely connect with me there. And, you're right. That is a way of quickly getting information out. So as something happens in the market, I can put a note out there. Or it's also a great way of just kind of thinking philosophically through what's going on, how we think about retirement, how we think about wealth, how we think about family, business. It's kind of a little bit more of a personal side. So I like that chance to kind of, I don't know if you want to call it offline or whatever. It's a little different than Facebook. It's not the same as Twitter, but it's a chance to have kind of a little bit more of a personal relationship.
Awesome. All right, Zach, it's always good to catch up with you. Thank you very much for joining me on the Wiggin Sessions.
Thanks, Addison.
Talk to you later.